Welcome to Get Rich Education. I'm your host, Keith Weinhold, the mindset that takes you from doubling your wealth to 10xing your wealth, how to get known as a real estate investor and why it matters, and the attraction of being deep in good debt. Grant Cardone and I are 10xing your wealth together today on Get Rich Education. The company that's provided our listeners with more loans than anyone is Ridge Lending Group, NMLS 42056. You can finance more than 10 single families up to fourplexes. Serving most U.S. states, their knowledge and experience leads to your financial freedom. They're number one in the investment space. Pre-qualify and then chat with President Chaley Ridge personally. Start on your next investment property loan right now at ridgelendinggroup.com. Finally, Total Control Financial gives you checkbook control of your 401k and IRA money to invest in real estate. It's time to get your retirement money into your own checking account, but you've got to avoid the little-known tax that you'll pay with any self-directed IRA. Instead, it's time for the QRP. Learn more and get your free copy of the QRP book by text messaging QRP in all capital letters to 72,000.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE, from Melbourne, Australia to Melbourne, Florida, and across 188 nations worldwide. I'm your host, Keith Weinhold. This is Get Rich Education, and when we talk about how to start building your wealth, it really begins by unlearning what you've learned and then beginning to ask yourself better questions. Now, to mine the basics, Rich Dad 101 stuff, really, going bigger is about asking yourself a better question. It's shrinking thinking to say, I can't afford it, when you don't have enough money for something. So don't say, I can't afford it, because that turns your brain off. Instead, ask yourself, how can I afford it? Because when you ask, how can I afford it, that turns your brain on, and you begin to learn how to become resourceful. Another example of what is not the right question is asking something like, how much should I invest in actively managed mutual funds versus an index fund? Well, look, successful investors don't ask that question because mutual funds have nothing to do with wealth building. They have nothing to do with the velocity of money or leverage or residual cash flow that you actually receive this month and all of your life instead of just someday maybe. I'll tell you a great question to ask yourself. It is, what is my time worth? Look, if your time is worth even a penny over $200 an hour, well, then you would not burn 15 minutes of your time filling out a form for a $50 rebate on your disposable contact lenses, because the economics of that transaction don't add up for you. Your prosperity would be diminished. You'd lose money if you lost 15 minutes to get $50 if your time is worth more than $200 an hour. So the time that I would say I can't afford it is perhaps when I'm referring to time and not money. I might say I can't afford the time. Well, if you're not at that point financially, well, then how do you get to that point? If you do it in a durable way, it's really going to start slowly by doing something like buying your first income-producing rental property, income that recurs without your involvement. See, that's how your time becomes valuable faster, because this is the genesis of you no longer trading your time for dollars. It doesn't start fast, but that's that inflection point. And today's guest, Grant Cardone, and I will discuss some of this shortly. You also reach a better point financially when you begin to harness other people's efforts. Look, if you're qualifying tenants based on the concept that they can't pay you more than 33% to 40% of their income for rent every month, well, then they're basically working for you, say, 33% of the month. That's the first 10 days of the month. The first 10 days out of 30 in the month is time that your tenant is therefore working for you. Now, just imagine 30 squares on a calendar hanging on a wall. And the first 10 days of all of your tenants' calendars have a dollar sign written in, filling that square. This is the typical income to rent ratio allowed by landlords. It's that the tenant's monthly income be 3 times the rent amount. So if you own 10 houses, it's like you've got 10 people working for you part-time. 10 households are paying you 33% of their income. That is just remarkable the more that you think about it. And you don't have to manage these tenants nearly to the extent that you'd have to manage regular employees if they were working for you. Now, no, not all of this income is profit, but look, the most successful companies in the world, like Apple, not all of their income is net profit either, and they sure don't get 1/3 of anyone's income, but you do. Look at all the stuff that people buy on Amazon. You want to talk about another successful company? People buy books and air filters and coffee, anything. But Amazon, even Amazon, they don't get 1/3 of anyone's gross income, but you do as an income property owner. So you need to care about your finances, and you just can't do that in the way that mainstream society does, or you'll only get mainstream society's result. Mainstream society invests through 401ks and similar plans. 401ks, those salary reduction plans that they take money out of your pocket every month. You need to get involved with something that puts money into your pocket every month. With a 401k, you are hoping to die before the money runs out. Every dollar that you lock in a 401k above the employer match is a dollar that cannot use other people's money now. That's why it's a losing formula, and you're only paid one way. With real estate, you use other people's money 3 ways at the same time. Yes, other people's money 3 ways at the same time. Did you ever think about that? You use the tenant's money for the income, like we've been talking about, the bank's money for the leverage, and the government's money for your tax incentives, all at scale. See, that right there, that is giving your money multiple jobs. Now, we want to be responsible providers and furnish good housing, or make sure that your property manager does. Look, I've been going to business and investing seminars for a long, long time, and I've seemingly heard everything from cash is king to cash is trash. The bottom line with what you need to do is give your money multiple jobs. Now you're building wealth and you're getting it to leverage other people's money. With a 401k plan, you're selling your time when you're young just to hope to get the time back when you're age 60 or 70 or 80 or older. That's a really bad trade. Did you ever take financial advice from poor people or people with these 401ks? Take it from wealthy people instead. Do what they're doing. Now, our guest today is known for both real estate and sales, but he'll tell you that he likes talking real estate more than sales. And you know, one thing that I like about him is that he's more open about what he does than a lot of others are. He mentions names of companies that he's doing deals with and the exact names of people that he's doing deals with as well. I spent the past few weeks in the eastern United States. I'm in Anchorage, Alaska today. Our guest is based in Miami, Florida. You're listening to Get Rich Education. I'm your host, Keith Weinhold. Grant Cardone and I together right after this.
Would you like to know the easiest way to create wealth and passive income with real estate? This is Marco Santarelli with Norada Real Estate Investments. Now you can access the best deals without the stress or hassle of having to find, renovate, or manage those properties. We save you time by providing you with passive income investment properties in some of the best U.S. markets. Learn more by downloading your free copy of The Ultimate Guide to Passive Real Estate Investing. There's no obligation and nothing to buy. Simply visit passiverealestateguide.com and get your free copy today. That's passiverealestateguide.com.
Countless property investors get killed with maintenance costs, but that's far less likely when you buy brand new construction. Let me tell you about JWB Real Estate Capital in Jacksonville, Florida. They pioneered the build-to-rent model where you can invest in new construction, turnkey rental properties. That's why JWB was featured on the front page of the Wall Street Journal. To learn more and see inventory, go to newconstructionturnkey.com.
This is our Rich Dad, Poor Dad author, Robert Kiyosaki. Listen to Get Rich Education with Keith Weinhold. And the reason I respect Keith, he's a very strong, smart, bright young man.
With me today is a New York Times bestselling author, major social media influencer. He is, in fact, the #1 sales trainer in the entire world. And he's a renowned speaker on leadership, real estate, investing, entrepreneurship, and finance. He owns 5 companies, and he holds over $1 billion with a B dollars in real estate assets. His Cardone Foundation helps at-risk people. Another company, Cardone Capital, is a private equity firm offering real estate funding opportunities in overlooked markets. And he's authored at least 5 books. The best known is the 10X Rule. Welcome to Get Rich Education, Grant Cardone.
Hey, Keith, thank you so much for having me. I appreciate it.
So good to have you here. So the namesake book, the 10X Rule, tell us just what is the 10X movement for people that don't know about Grant Cardone.
The 10X Rule was the 5th book that I wrote. I've written 8 books, all business books. And that book was really trying to help me figure out, I was writing basically to try to figure out, it was as hard as I was working, why I was not getting ahead and didn't have protection from market corrections. So 2010 taught me a lot of lessons. I was buying real estate at the time, and the real estate that I was buying is the thing that actually got me through that recession. My other 2 businesses got cut in half. And the 10X Rule is, the name came after I wrote the book because I was looking for a solution to constantly having to struggle and never feeling like I was getting ahead. And basically the 10X Rule is like, look, you got to scale bigger, think bigger, and go bigger than you imagine, than your goals or dreams allow you to.
I'll tell you what I think about 10X. Tell me if you agree. I mean, 10X basically says it's easier to go 10X than 2X because when you're only trying to 2X your business, which means double your business, you're still thinking in the same box. It's just hard to stretch out that same box because you're still using the same business systems and the same team, but you're just trying to stretch it. 10X says it's easier to just go get a bigger box rather than stretch the existing one.
It forces you to ask a better question. Unfortunately, we're held down not by our potential, by the questions we ask ourselves. And when I started asking myself, hey, what if I own 10,000 units rather than 100? I mean, everything changed for me because, if you're going to buy 10,000 units, then you're no longer worried about bed bugs. You're going to have them. You're not worried about roofs and tenants and termites. Now you're like, okay, how do I scale this thing? How do I find deals? How do I fund these deals? How do I have a management company that can support that much product? So it just changes the questions you're asking yourself. And it's my experience in my life and with most of the people that I meet, I've had some opportunities to meet some unbelievable people. Most of them agree with me that they all underestimated what they were able to accomplish. And when we started thinking bigger, things got easier, just like you said.
And thinking bigger is part of the problem. So you bring up the example of instead of saying you're going to buy 100 units or whatever it is, you're going to buy 10,000 units. Right there, we know that comes down to a 4-letter word that starts with F, and that is fear. People have that fear of thinking bigger and going 10X, just like some people will pass up a $1 million opportunity just because they're looking for a job, and they have the same problem with going from 100 units to 10,000 units. That scares them. So how does one overcome that fear? What is part of that mindset?
You got to do the math on, when I started buying real estate, I went and bought what I could afford. And I think this is what most people do. They start with their budget. You said it starts with an F word for fear, but it also starts with like funds. Like I was buying on a budget. I'm like, okay, I have this much money. What will that buy me? When I started investing, I was still buying groceries. It was weird. When you're investing, the best thing to do is not invest with a budget. It's to get a good deal, even a great deal. Sometimes great deals are bigger than you were thinking. and we can't see what we're not looking for. So if I'm limiting myself to my budget because I have this much money, that means I can buy X. That might not be getting you the best deals. If you study the most successful real estate investors on this planet, they're not worried about money. They're worried about the opportunity. Just what you said. Most people are looking for a job, not $1 million opportunity. These guys are like, hey, I'll figure out the money. I'll figure out the funding. I'll figure out the debt. I'll figure out everything. But let me make sure I'm doing and building something where there's an enormous payoff for more than just me. Because the payoff, it has to provide investors' returns, the banks and lenders' return. It's got to provide them with, assurances that they can be paid back, et cetera. So the bigger the think, the easier it is to get those deals done. And my first deal was I had $3,000. I said, what can I buy with $3,000? I could have just as easily bought 10 of those deals right from the get-go, except I had a lot of people around me saying, hey, take baby steps, walk before you run, all that stuff that's maybe not necessary.
Yeah, a lot of that is small think. When one goes bigger, I'm hearing you talk about other people. In a sense, one gets less selfish because you're asking how you can bring others along for the ride rather than only using your money, like the $3,000 you mentioned. Instead of just thinking, how can I get my money to work for me? You're thinking, how can I ethically get other people's money to work for me?
They have to win. And I think a lot of people don't want to get other people involved because they have a sense of responsibility. Most people are good. They want to pay people back. Most people are not criminals. I've known a couple of those, but most people are not. The moment you start thinking bigger, you're like, oh, I'm going to have investors involved. I'm going to have banks involved. People that talk about not using debt. You got to have a high responsibility to take debt on. Now you got to do all the math. It's a much safer thing to pay cash for everything. When you start taking on debt, taking on investors like we have, I think I've done $600 million worth of deals this year in the first 9 months. That's more than I did my whole career.
That's astounding.
The first 20 years. And now I'm actually helping people. Now the deals that I'm looking at are so much better. And so if somebody's listening right now and you're like, well, I can't figure out my first deal. Maybe you need to start doing the math on 10 units or 20 units or 30 units or 40 units. So at least you can start walking through the math and asking yourself, what I need if this was possible? What funding would I need? And then maybe the funding will show up. What banks would I need relationships with? What kind of deals would I need to look at? What kind of relationships would I need with brokers? What markets would I need to be in? Start asking great questions. When I started asking great questions of myself that were big, I started doing 300 units at a time rather than 3 units at a time.
You put yourself in a better position when you start to ask yourself better questions. And when you can do that, when you begin to think bigger. Well, a lot of this involves relationships. You're talking about other investors and other banks and getting in the deal flow. Grant, something that you have done just an astounding job of, and I would be remiss if I didn't ask you about it, is getting your name out there and becoming well known. Now, I know some of you listeners may not care about becoming well known or you think it's not that important, but when Grant's name keeps recurring in your life, you've heard of him, you tend to get that know, like, and trust factor. And Grant, I've heard you say something really interesting before. It's one of the favorite things that you've ever said. And you say something like, I'm Grant Cardone. And if you haven't heard of me, well, then that's my fault, meaning your fault. I absolutely love that. So tell us a bit more about that and about becoming better known and how you've leveraged social media to help yourself do that.
My dad died when I was 10 years old, and he was well known in the community. When my dad walked in, he had friends everywhere he went. He was a very friendly guy. People liked him. And when he died, I didn't really learn that lesson. I didn't know because I wasn't connected. When the guy dies and you're a kid, you're 10 years old, then you got to start figuring stuff out on your own. So I wasn't a rich kid. I was born middle class. We didn't have a prominent name in the town. Nobody owed my dad any favors, but he was known. Well, sooner or later, that wears off. I mean, people forget about you pretty quickly. I did not know how to go make connections. They don't teach it in high school. They don't teach it in college.
That's right.
Rich kids seem to know how to do this, because they're at the country clubs and they're skiing and they're going places where people influence things and value connections and names and stuff. I didn't know this. I thought it was important who I knew. I know today that it's more important that people know me than who I know. And if my name sounds familiar, it's easy and hard in the real estate space because the real estate space, particularly commercial real estate, is not social media friendly. It's a bit frowned upon. Almost no one's doing it in my space. particularly the commercial, the big property stuff. I got a $90 million deal in Houston, Texas, off market because the guy that runs the third largest apartment holdings in the country, Fairfield Residential, Gina Barra, his son follows me on YouTube.
Yeah.
I had a meeting with Gino. Gino never heard of me. Okay. He's one of the biggest players in apartments in the world. And if Gino don't know you, you're probably not going to get a deal. And when I called Gino, he didn't know me. I convinced him to put my name on his calendar. He did. His kid walked into the office one day and said, "You have a meeting with Grant Cardone?" I mean, the kid's 19, right? The dad's 55 years old. And Gino's like, "Yeah." And he's like, "Oh my God, that guy's a god, blah, blah, blah." The kid started, just like slobbering all over his dad. And I got that deal because now Gino knows me because of somebody he trusts. People do business with people they know.
Yeah.
There's an old saying that people do business with people they trust. The truth is they got to know you before they can trust you. If they don't know you, your honesty doesn't matter. Your price doesn't matter. Your terms don't matter. If they don't know you, they haven't heard of you. You're not doing deals in the marketplace. They're not seeing something written on you. I Google your name and I can't find you. I mean, there's only one thing worse than me finding something bad about you on the internet. And that's me finding nothing.
Nothing. Yeah, exactly. Grant, what you're saying, it's something I validate every day, but it's only subconscious. I see deals come across my desk every day. And you know what? The easiest way to throw away a deal is if I've never heard of the person. I just don't have time to look into it and delve down into it. So I delete that. But for maybe the 10 or 20% of people where I have heard of deals, hey, well, I would consider that one because I've heard that person, because there is that trust factor there. So I basically validate this getting known factor every single day.
The hardest thing in real estate is not the money. I know if you don't have money right now, you think money's the biggest deal. The underwriting's not the hardest part. The hardest part of real estate is finding the deals. It's getting a broker to call you back. Okay. It's getting a seller to actually take you serious. Like getting the real estate is the hardest thing for me in the game.
Yeah.
And, I'm competing against people like Blackstone and Goldman Sachs and pension funds. Like they have all the money in the universe and they have all the brand recognition. How do I get the seller on a $140 million deal? We just closed a $140 million deal from a group called EQR. Who's going to buy a $140 million deal? Pension funds, life insurance companies, Goldman Sachs, Blackstone, the list, right? All the rich. I'm not talking about people now. I'm talking about the richest institutions on the planet worth trillions of dollars. They could burn Warren Buffett's money. These are institutions, right? They're running the planet. How do I get the seller to know me, to be aware of me, to value my offer as much as they would at Blackstone? The only way to do that is to get known and make sure they keep knowing you. You keep making announcements in the marketplace. You keep showing up at their community meetings. They keep seeing your face. You have to get out of obscurity with people, meaning I have to know you and I have to remember you once I know you.
I've got something to tell you, the listener. The first time I talked to Grant, the first question he asked me that was not about myself is Grant wanted to know how I learned about him. It was important to him that he know that. For an actionable takeaway, Grant, is it as simple as people just need to create more content and then share it, whether that's an Instagram story or a Facebook post or whatever it is? Is that the takeaway? Create and share?
Yeah. So let's say you're a plumber and you're trying to buy real estate in your market.
Yeah.
Most people are not born into the real estate family. You're doing some job. You got a job and then you start investing in real estate. That's how I started. I had 2 companies and I started buying real estate. So I didn't have Facebook and LinkedIn, all these unbelievable tools to get known. I didn't have back then. But what I would do today is if I'm looking at deals, if I'm a plumbing company, I need to announce, I need to be on social media talking about my plumbing business and where I'm located. And if I'm looking at property in the local area, I need to make sure people know that I'm looking at property. If I bought something, I need to announce that I bought it. People are trying to, I'm going to keep my secrets quiet and I'm not going to let anybody know anything. And it's like, what are you doing? Nobody does that. Blackstone just raised $20 billion because they're known. They had a $15 billion fund and they didn't get $15 billion. They got $20 billion. So why? Because they're known, period. The banks aren't going to give you money. The insurance company's not going to support you. The investors aren't going to come play with you if you're not known. So anything you can do to let people know what you're doing, what you're looking at, help people, be of service to people, teach people your secrets. They're not going to become competitors.
In the sharing economy, hiding is not helping.
No. A lot of people, think that, if I tell people what I'm looking at, I won't get the deal. So announce the deal that you closed, announce the deal you looked at, announce the deal you lost. Ask people if they know anything about a piece of property you're looking at, or just talk about your plumbing business, which would be important too.
But Greg, you're basically known for two things beyond getting known, and that I think is real estate and sales. And I've actually heard you say that you like real estate more than sales, and you've had a lot of interesting commentary on real estate that makes a person stop and think. And I think part of that is maybe is in part of the Rich Dad School is the whole fact that really, in a sense, your house is not an asset. In fact, one of my favorite quotables that you have is in real estate, if it has one door, rent it. And if it has many doors, own it. Tell me more about that.
Yeah. So I was on the phone with one of the guys from Shark Tank yesterday, and they're like, we had a 30-minute conversation. And right before he got off the phone with me, he's like, hey, can I ask you something? I saw this thing you wrote about houses, the one door thing. And I said, yeah. And I said, do you want to know this for you or somebody else? He's like, oh, no, it's not for me. It's for my buddy. My buddy's got 4 single family homes and he rents them and it's a good deal. And then I saw what you said about the single door. And I said, well, look, all I'm saying is my first deal was a single unit. It was 1113 Sheffield Street, Houston, Texas, $78,000. They had one front door, one back door, one way in, one way out. And the problem with one is it's one. You've been married 15 years, okay? One wife is probably the only thing that you should have one of. People tell me that one kid's more trouble than 2 kids because at least they can play with each other. So in real estate, the number of doors is going to give you protection. A house is not an investment. Nobody can sit down with a piece of paper, a pen. If they get rid of their emotional connection to the house, there's no way in the world. And I've made a bunch of money on homes that I've lived in. So when I say that a home is not an investment, in fact, I would say a home is a terrible investment. That does not mean I haven't owned homes. And it does not mean that I didn't make money on homes.
Sometimes you just get fortunate and ride a capital gain at a nice time in the market.
Yeah, exactly. Look, I made $9 million on one house once. And I'm the guy out there every day saying a home is a terrible investment. So because if I'd have taken that same money and bought 500 apartments, I'd have made $39 million without the headache and without the sweat and with the income. So number one is, and you and I have this in common, is cash flow is the holy grail of all businesses.
100%.
It is the ultimate protection against all downturns, recessions, contractions, and the more doors can prevent people from losing things in the cycle. When the cycle's down, it's like, who owns this piece of property? Because at some point you're going to own it and make money if you can stay with it, and cash flow allows you to do that. A single family home provides no cash flow.
Primary residence is a lousy investment because you pay it every month. You need to buy things that pay you every month that positively cash flow 100%. So you talk about acquiring real estate. You mentioned paying all cash earlier versus debt. And I think some people have a limiting mindset around debt and they don't want to use too much debt for real estate, even at a time when interest rates are historically low. My point is with debt in a cash flowing rental, your debt is therefore completely outsourced to a tenant as long as there's durability in that income stream. So tell us about how you like to use debt in real estate. Do you want that leverage? Are there situations in which you want to pay all cash when you don't actually have to? Tell us about that.
I mean, the only reason I would pay all cash for anything is because I'm getting some kind of deal. I can move on something fast, but I'm going to put debt on that property. There's no doubt I'm putting debt on it. Like, I will never, ever pay off anything.
You're like me.
Your listener they got to decide whether they're going to listen to Dave Ramsey or whether they're going to listen to Apple Computer. Like, we get our advice from, no offense to Dave, but Dave's no debt thing was born out of a loss. It was born out of failing. He took on debt. He misunderstood it. He borrowed too much money for the wrong things. And then he built a career out of don't borrow money. Look, Apple Computer's got $270 billion in cash today. And they borrowed money from Japan last week. Like, it's freaking crazy, dude. Like, Google's borrowing money. Amazon borrows money. Like, these companies are printing cash.
Mark Zuckerberg borrowed money for his own personal home and he didn't have to.
Exactly. Why? Right? If you want to go to Mars, you're going to borrow money and you're going to have investors. The only reason people don't want to borrow money and they don't want to get investors is because they're thinking too small. They're selfish. They're little selfish people. No offense, because I'm talking about myself. I'm trying to offend anybody. When I was thinking about paying my house off, who am I thinking about? I don't want to make a payment. I have some illusion that I'm going to rest on my couch all day and not have to work again. Paying off your debt, paying off your house, it's about you. Borrowing money means you can get big enough to actually have responsibility and create jobs.
Yeah, it's a whole don't live below your means, expand your means.
Yeah, I love all these sayings you got.
At Get Rich Education, we say financially free beats debt free. Debt free just means you don't owe anyone anything, but you might grind and eat dirt or work at a soulless job that you don't want to work at for decades just to retire debt. But that's not the same as growing and expanding your portfolio. And financially free means you put yourself in a position such that you have so many income streams that you can do whatever you want to do whenever you want to do it. Financially free beats debt free.
Yeah. I want to own property that is so valuable that banks want to give me money. I'm not having to pull teeth. These aren't hard money loans. I'm not going to the mafia to get money here. I'm like, these people have money. Money is what? What is it? It's printed. It's printed pieces of paper that was made up. What is debt? A printed obligation. So the cash is an obligation too. I traded time for some money. I mean, I can't keep $30 and $40 million worth of cash in my cabinet. So what am I going to do? I'm going to take that money. I'm going to give it to the bank. They're going to hold on to it, convert it to digits. I'm going to call them up one day and say, use that $30 million to buy $100 million worth of real estate. So that's the kind of leverage I look for, like 1 to 3. Okay, I buy $3 worth of real estate for every dollar. And I'm like, okay, 30 million, bought a $100 million piece of real estate. Let's just do simple math here. If I keep it 30 years and pay it off, 30 million turned into 100 million. But I didn't pay the 70 up, right?
Right.
Now, that's if the rents don't go up. That's if I don't refinance it, which I would. Again, I would never pay this thing off. I'd refinance this property 10 times in the next 30 years, maybe 4 or 5 times over the next 30 years.
If you're not borrowing, you're losing your leverage.
Yeah, exactly. So every 6 to 7 years, I'm going to pull my money out. It's going to be a non-capital, a non-taxable event. So 30 million, I should be able to get the entire 30 million back for the $100 million property. If I get just gradual 3% rent increases, I should be able to get my equity out of that $100 million property at 7 years. I got 30 million. I can go buy another $100 million deal and keep this one. And that 30 million was not taxable. And I can do that a second time, a third time, a fourth time. So that's how wealth is created on this planet, not just in the United States. Yeah, you can't do that with a house and you can't do it with one unit.
And you can't do it if you just try to pay off a small portfolio. See, this is how wealthy people talk. You're talking about the velocity of money, recirculating it over and over again right now.
Yeah. Again, it's not what Dave does, but it is what the rich, the wealthy, the super wealthy institutions. You know, when we talk about the wealthy people, most people are thinking about the rich guy or gal. That's not who I'm talking about. I'm talking about the institutions, the companies Warren Buffett invests in. Imagine he's investing in companies. He can't buy the whole company. That's what I'm talking about. Follow what those companies are doing when they're doing it right. What do? They get known. They're on every shelf. They use debt. They access debt from all around the world. They make sure their products are on, great locations. Starbucks has got great locations. McDonald's has got great locations. It's a real estate play. Everything's a real estate play. On the internet, where do you want to be? You want to be on the top line of a Google search. If you're going to buy an ad, you want to be the top line. Then when you go to Facebook, I want you to see Grant Cardone there. I'm going to follow you all over the internet, okay? I'm going to use worthless pieces of paper to buy real estate on the internet so that you finally get used to my name. So you call me up one day and say, hey, man, I'd like to interview you on my show and introduce you to 15,000 real estate investors.
You just multiplied yourself. Well, hey, one last question that I have for you. It's somewhat of a personal one, and it's really more important than everything else we've talked about in a sense. I mean, in your life, you're trying to balance a lot of things: fitness, finance, faith, fun, family, all those things. Let me ask you about the fitness, because you stay remarkably fit even as you're doing all these things. So tell us about fitness and how you prioritize that in your life.
Yeah. Well, I get up in the morning, I go work out every day. So maybe 8 days all last year that I didn't get a workout in. So I just make the time. And I'm not doing it for aesthetics. I'm doing it for my body started hurting about a year ago. I was in pain all the time. And I'm very anti-drug. medication, Advil, Tylenol. I know that's just going to cover up whatever the pain is. And I just finally said, okay, I got to get in the gym. I got to start putting muscle back on my bones. It's use it or lose it. Look, your body's like money. Ignore it and it will disappoint you.
Take care of your body. It's the only one you're ever going to have, and you're going to be living in it your entire life.
Take care of your body. Take care of your money. Take care of other people's money. Take care of your wife. That's what I say.
Well, great. You've helped take care of our listeners today with a lot of great insights. If someone wants to learn more about you, what is the best way for them to do that?
You can always Google my name, but you could also look at what we're doing at Cardone Capital if you want to see the deals that we're doing, every deal that we're looking at and or buying, how we access debt, what we're buying is at cardonecapital.com. Also, if your audience wants a free book, they go to cardonecapital.com/book. It's free.
That might be a great place to start. Grant, it's been great having your insights here on the show. Thank you for coming on today.
Thank you, Keith. Appreciate you.
Yeah, a wide-ranging chat with Grant today. Get known, hiding isn't helping. Really, what it comes down to is that the more friends you have, the more successful you are. Grant says, announce that you closed on a deal. Well, I see a lot of people do that. Interestingly, he told you announce the deal that you lost as well. I don't see people use media to announce deals that they lost very often, but that could be a great approach. Announcing a loss is probably going to connect you with like-minded people or people that can help you land a similar deal successfully. Think about how problem solvers would swoop in to help you if they saw that you lost a deal that you wanted. When it comes to getting started in real estate, your first rental door is indeed your toughest one. Yep, if it becomes vacant, then you have a 100% vacancy rate. And additionally, your one door or your one building is only in one geographic market. And sooner than later, you want to be invested in multiple real estate geographies for diversification. Paying off your debt, when it's good debt, fixed interest rate debt tied to a cash flowing property, paying that off is selfish, small, secure. And what it really does is it makes your portfolio cave inward rather than expanding outward. So get known and don't avoid debt. Instead, learn how to use debt and then get that debt. Big thanks to our guest today, Grant Cardone. If you're a successful person, you risk your own money for freedom. If you are an unsuccessful person, you exchange your freedom for money. And I think that it all comes back to where we started today. To bring things full circle, it's about asking yourself a better question. A poor question is, now how do I work more overtime? That's a poor question because it's designed around trading your time for dollars again. You're selling your time for money once again. Now, if overtime pays time and a half, at least you're getting paid more dollars for your time. You might even have to do that in the short term. I understand that, but that's just putting a patch on the problem. And usually you're also not learning anything new. You're just doing more of what you already know how to do. You're trading away your todays for tomorrow. So instead, get your money to do multiple jobs. That is better than you doing one job. You can't only hope that things change. For things to change, you've got to change. Those that don't take a chance don't have a chance. Well, hey, we talked a good bit about mindset reinforcement today. Over the next few weeks, we're talking more about actionable strategy as I discuss planning for a recession one-on-one with you. I'm also going to discuss buying and owning existing construction real estate versus brand new construction real estate. I can think of at least 8 pros and cons for each one of those, including some that you've never thought about before. Also, we're going to do a fresh episode on fourplex buildings. What makes 4-unit properties so special? Fourplexes have some unique qualities that you cannot get in a 3-unit or a 5-unit or even a 100-unit apartment building. The way that you can get these valuable free wealth building episodes delivered directly to you over the next few weeks is for you to subscribe to Get Rich Education. And if you aren't already one of our tens of thousands of regular weekly listeners, I'd love to have you come along for this eye-opening ride. We do new shows every Monday. Here in our 6th year of broadcasting, we have been that eye-opening finance and real estate show. I tell you why financially free beats debt-free, why compound interest is lame, and how leverage makes you wealthy instead. Another eye-opener is how your return from home equity is always zero. Now, real estate is an awesome investment, but your return from home equity is and always has been zero. In fact, I even wrote an article with that same title and had it published in a few places, including Forbes. That's because these things, as eye-opening or jaw-dropping as they sound, are all irrefutable facts. The guests that we've had here on the show over the years really are the most elite in the world in investing. Rich Dad Poor Dad author Robert Kiyosaki was here with us this year for the 3rd time. Also, T. Harv Eker, Chris Martenson, the Rich Dad advisors like Ken McElroy, Tom Wheelwright, and Garrett Sutton have all been here a lot. Economists Jim Rogers and Jim Rickards, and that's just off the top of my head. Also, the man that actually invented the 401k plan was here with us last year. Talk about eye-opening. His name is Ted Benna, and even he, the 401k inventor, told us that the plans are not serving people. And every few shows, there is no guest, and it's just me on the microphone directly helping you build your wealth. So if you're ready to stop following money and you want to learn how to make money follow you, I'd be grateful to have you join us as a Get Rich Education subscriber. Either way, I'm grateful to have you join me today. I'll be back next week to help you build your wealth. I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.